Welcome to the Canadian Investors Course, Session 2, Income Investing Continued. And we encourage you to read page 2, Terms of Use and Disclaimer, prior to continuing. Slide 3 is a cartoon. In the cartoon, you can see Uncle Sam trying to foist off his deficits on Uncle Sam, who's got an empty coffer. Of course, Uncle Sam could fill the coffer from the pockets of the U.S. taxpayers. Session 2's topic is medium and long-term income investing. Slide 5 is a quiz. I won't give you the answers to this quiz right now, but it's an important thing to look at because it's important to understand what conservative means and what aggressive growth means and balanced. So what you should do, if you like, is look at this. There are 4 pie charts, 1, 2, 3, and 4. They're a blend of fixed income, Canadian equities, U.S. equities, international equities. What I encourage you to do is to look at each one and label them with what they are. For example, is number 4 the conservative one, or is number 1 the conservative one? And what is number 3 and what is number 2? Like, which one's the growth one, which one's the balanced one, which one's the aggressive growth one, and which one's the conservative one? And I encourage you to discuss this with your investment professional. If you're using a trusted wealth professional, all the better. This is a good starting point to understand what investments really are in the context of the current market, as well as what your comfort level with risk is. This is a valuable starting tool. Slide 6 talks about the bond market and debentures. What's the difference between a bond and a debenture? Well, a bond has an asset attached, or there can be absolute protection and coverage. Governments can issue bonds, for example, because they have the power of taxation, and therefore they can absolutely guarantee that they can deliver the face value at the end of the term, regardless what happens in the markets. A debenture really does not have an asset attached to it, and nor a credit, nor a guaranteed cash stream, and therefore really debentures depend entirely on the good credit of the company. In other words, the credit worthiness of the company, the ability of the company to pay. So this segment is going to look at what is a bond, what's it look like, what makes bond prices move, talking about bond pricing and examples of how you can profit and lose money in the bond market, there are different ways you can buy bonds, and what type of bond investors exist. On your what you should be looking at right now is chart number 8, and this is what is represented on chart number 8 is a depiction of the way a bond is looked at by the market. There is a residual, which is part on the left that says Province of Ontario, $20,000, 5%, October 15, 2023. That says it's issued by the Province of Ontario. It's got a $20,000 face value. It pays 5% interest on that $20,000 face value, and it matures October 15, 2023. Then next to that are 2 columns, $500 each, starting in 2014 and ending in 2023. You'll notice there are 2 a year. And if you add all those $500 amounts up, that amounts to giving you 20% per annum for the period from 2014 to 2023, 10 years. So this is an example of what a 10-year bond used to look like when bonds were issued in paper form, with a residual being the ticket on the left and the coupons being all the little $500 tickets on the right. Now, you may notice that this wouldn't be a very useful bond, because back in the day, if you've heard the term clipping coupons, people used to actually clip off the appropriate coupon for the time. So for example, your first coupon would be the 15th of April 2014, and you'd take it into the bank and they would give you $500 for it, and that was your interest payment. Nowadays it's all done electronically in your account. You never see a paper bond. And also, the way this particular bond is set up, it wouldn't work, because the 2014 through 2018 coupons need to be the first ones, because those would obviously need to be clipped first. Anyway, moving along. So let's consider this bond, which we just looked at a moment ago. And as I said, the issuer was the province of Ontario. It had a face value of $20,000, coupon or interest rate of 5%. The issue date was October 15th, 2013. The maturity date was 2023, 10 years later. Payment frequency is semi-annual, and the interest payment was $500 every 6 months. So in the bond market, what makes bond prices move? Well, interest rates, risk of the issuer, and the economy. All of these three things have an effect on bond prices. Now, we're getting into the more interesting part, interest rates and price. Basically, you have to remember that the key thing with bonds is that as interest rates go up, bond prices go down. As interest rates go down, bond prices go up. They're issued with a $100 face value. They mature at $100 face value, with interest payments between the issue and maturity dates. However, as well, an investor can buy and sell a bond on any given day in the markets, because they trade on a regular basis. But how would we determine the price that you should receive? Well, part of it is whether interest rates are moving up or down. That's going to determine whether the price of the bond is moving up or down or not. As well, the rating of the bond is a key factor. If the bond is rated, let's say, single A, and its rating deteriorates to some reason, then the bond price is going to go down. If the bond gets re-rated a little bit higher, the bond price will immediately jump to correspond with the newly acknowledged quality of the company. As a retail investor, you're probably advised to stick with single A or better bonds to avoid surprises. Those would be for corporate bonds, for example, in debentures, and probably triple B for provincial bonds. And you should make sure that the makeup of the bond fund matches your tolerance for risk. So don't accept good quality as an answer. You need to know what's in your portfolio. A conservative bond fund should contain less than 30% corporate debentures, and you probably need to ask your salesperson if that's the case. Now, examples of bond price movements. Let's say we have a couple of bonds and they both sell for $100. So the first exercise is, what happens if rates fall 2%? So let's explore what happens when interest rates go up and down and how it affects the value of the bond. So interest rates fall 2%. So 5-year Government of Canada 5%, 15 October 2021 bond, the value of the bond is now $109. And if it were a 20-year, it'd be $130. So that 100-year bond, after a 2% move, is up 9% in value if it's a 10-year, a 5-year, and if it's a 20-year, it's up $30 in value. So that's really quite substantial. Now, what happens if interest rates rise by 2%? Because that was when interest rates fell by 2%. If interest rates rise by 2%, that would mean that your $100 bond, the 5-year bond, would be worth something like $91.50, and a 20-year bond would be worth $78.50. In other words, completely favorable to the earlier. So how do you buy a bond? Well, you look at the prices. There's a bid and an ask spread, just like there are with stocks, and you have to account for accrued interest. If you want to know a little bit more about this, again, talk to your trusted wealth provider, or go to zenwealth.com. There's a link on the page 12. Bond price rules. The longer the maturity of the bond, the more volatile the price of the bond, and vice versa. So short-term bond, not likely to have a lot of volatility. Long-term bond, maybe a lot of volatility, which may make it look like a higher risk investment too. So the price of a bond is affected by a change in credit rating. Bonds mature to the original issue price, $100. You can make a significant amount of money trading the bond market, but you can make capital gains as well. By buying and selling bonds, you're basically a rate anticipator. So in other words, if you're trading bonds, you're anticipating the movement of interest rates. And bond funds move up and down with rates too. So you have to know which direction interest rates, or believe you know which direction interest rates are going, to know whether it's a good idea to be heavier on the bond funds or not, or to be heavy on bonds or not, for that matter. Preferred shares are another fixed income vehicle, which are kind of like a little bit of a hybrid. They're similar to stocks in that they pay dividends, not interest, and they may or may not have a final maturity, so they could be perpetual or they could be some other form. They trade on the stock market, so that makes them similar to stocks. The part that makes them similar to bonds is that they have a preferred dividend, which is a fixed dollar amount, and it's paid in preference to the common shares. In other words, for the dividend to be suspended on the preferred shares, there'd have to be a meeting of the board of directors, and they would have had to eliminate the dividend on the common share first. They tend to have a par value, typically $25. Interest rate movements affect the prices, just like they do to bonds, and they have a credit rating, a P1, P2, or P3, which isn't too different from the way bonds are rated for credit. They may have some special features as well. If we look at preferred shares, again, preferred shares are issued at $25 a share. They have a set dividend, and it pays quarterly. There are special features on some preferreds, like retraction. A retraction feature may exist where the investor has an out option. There could be a redemption feature where the issuer has an out option. There are fixed floater bond preferreds, which are not that common right now, but they're another feature that's available under certain market conditions. Rate reset preferreds are extremely common nowadays. Those are preferred shares that have a fixed reset calculated, factored into the price to the bond when it was issued, which says that it will reset 5 years out at a specific premium to a Government of Canada bond. So the idea is that these have some inflation protection on them. There are also perpetual preferreds. These are preferreds that never expire, and convertible preferreds. Convertible preferreds are preferred shares that can convert into common stock under given correct circumstances. So the next issue is taxation of income. Well, if you look at all your income, if you get your interest income is taxed at your marginal tax rate. So if you're making $150,000 a year, and your marginal tax rate is therefore 46.5% in Ontario, then your interest will be taxed at that 46.5%, which is your marginal the full amount is taxable at your marginal rate. Capital gains income is taxed at half the so half the capital gain is taxed. In other words, if you receive a capital gain of $2, $1 of that is taxable. Now, another way to look at it is that you pay, instead of paying approximately 46.5% tax at the top marginal rate on a capital gain, you pay about 23% tax. So that's one way to look at it. So for example, if we want to build an example, if we were to buy 100 shares of BC at $25, which makes a $25 makes a $2,500 purchase, and we sold those shares at $26, giving a result of $2,600, we'd earn a $100 capital gain, and as a taxpayer, we would only report 50% of that gain as income, which would then be taxed at our rate, our marginal rate for that year. Dividend income is, as long as it's eligible dividend income earned from Canadian corporations, it's grossed up by a factor. In 2012, that factor was 38%. Now it's a little bit more than that. And then the federal dividend tax credit of 15.02% is applied. So, for example, if we got $100 of dividend income grossed up to $138 using the 2012 numbers, then our federal tax would be $40.02. Our dividend tax credit would be $20.72. Net federal tax to pay would be $19.30. The net provincial tax would be $6.57. So the total tax would be $25.87, and the result is that you'd keep $74.13. Nice result. So to summarize the taxation of incomes, interest income on a person earning $100,000 in taxable income as of June 2016, the marginal tax rate on for interest income for that individual would be 43.5%, approximately 43.41%. They would pay 25.87% on dividend income and about 21.71% on capital gains income. So clearly, if you could, you'd want all your income to be capital gains, which means you need growth from your stocks. Having said that, don't chase growth at a higher level of risk than you're willing to tolerate. Now, there are two types of fixed income investor. There's the conservative investor. That would be like an insurance company, for example. They buy high quality bonds and debentures, BBB or better. They want income from the bonds. They buy them as new issues and they hold them to maturity. That's exactly what the insurance companies do when they buy bonds. They don't worry about the price of the bond over the life of the bond. They worry about the price they paid and the amount they redeem, and the interest they'll receive along the way. A more aggressive bond investor might go ahead and buy that new issue bond just like the insurance company did, but they probably would be looking to hold it for a shorter period of time, maybe 3 months to a year. They'd try to anticipate interest rate movements. They might even buy longer bonds to maximize the return, and they might buy their bonds on margin. Now, buying the bonds on margin means they borrow some money to buy their bonds. And if you're wondering why that would be a good idea, that's a good time to talk to your trusted wealth professional too. Why on earth would you do that? Well, these are important things to understand. And the aggressive investor might hold them for a shorter period of time, looking to trade them. They'd be anticipating the interest rate movements. They buy long-term bonds to maximize return, and they may well even buy them on margin to increase their opportunity. That is the end of session 2. If you have any questions for a trusted wealth professional, please contact Jerry Gabon at 905-203-1162. Thank you for listening. Bye for now.